Hey gang, thank you all for being here. This is Hey Gang, beast of a session. And I want to express a big thank you as well to M1. This is the latest in our series. We call it the I Got Challenge series. It's where people make the case and they ask me to kind of rebut what they lay out. Now, M11 or M11, I'm not sure exactly. I'm going to call you M11, laid out a brilliant case. Why? Their thesis is that the markets, crypto and equities, will tank in November and December. Remember, they're correlated. So one goes down, the other one will go down too. But there is a little bit of that decorrelation, decoupling, but we'll talk about that another time. But this is a brilliant case, and we're going to touch on a ton of stuff. This is a beast, but everybody will pull a lot away from this. There is so much information packed in here. This is bigger than a Sunday Q&A video. But again, let's go. First, edutainment doesn't really matter for this particular video, and this is the first part of the question. And from M11, why the market will crash by November, December 2022. Now, this is a 7-part series. Each of these parts has multiple elements to it, so we'll just jump right in. First of all, first issue is inflation is still high, according to CPI. It increased 9.1% year over year in June, 8.5% in July, and yes, it came down last month, but we're still way above the Fed's 2% target. All true. We agree. So a quick reminder as to where inflation is and where the Fed target is. This little graphic says it all. The yellow is the inflation line. The big red arrow is where the Fed want to go. And we are a long ways off. The 8.3 all the way down to 2, 6.3%. How do you smash down that level of inflation? But first, let's take a step back and talk about deflation. Yeah, I know timing is everything, and I know people like Cathie and sometimes Elon Musk are a little bit off the mark, but they are ringing alarm bells. Cathie, I spoke about this before. PPI, CPI, PCE, everything is way off the C19 price peaks. Lumber, copper, oil, iron. I'll talk more about oil later, very important. Dram, corn, freight. Freight rates are down 80%, and they're tanking. Gold, 70%, silver, 40%, which is shocking. But Elon Musk, he believes another major Fed rate hike, and that was before the last one. He said it risks deflation a lot. And he has his fingers on every economic indicator, every supply chain on Earth. He knows what's happening. He senses it all around the world, from the metrics around selling vehicles to building them, to labor, to raw materials, to supply chains. He has his fingers and everything. He's also a very smart guy. So love him or hate him, he's sounding the alarm. So let's look at some data here. Inflation expectation here. This is the Exhibit 8 from Bank of America Global Research. Inflation expectations near 18-month lows limit the market's perception of how much further the Fed needs to tighten. Okay, inflation is falling so fast that deflation is becoming a real risk. That's the message here. Let's look at the inflation swap rate. And this is from Bloomberg Finance and JP Morgan. This is the 1-year US dollar inflation swap rate. It is at 2.25% right now, ladies and gentlemen. And there are no inflationary expectations by consumers or the market. And this 1-year swap rate proves it. The Fed is tightening to protect the US dollar strength, and there's no real risk of inflationary snowball. Deflation is coming, but hold on to the very end, because there's another wrinkle on this one as well as we go forward. Next in the box, section 2 of 7. So we're going as quickly as we can. What the Fed is saying, well, they will keep raising rates to fight inflation, and there will be pain, as Jay Powell says, by destroying demand. They will remain hawkish longer than you can stay solvent. True. They want stock market, and by extension, crypto, real estate to crash. Higher rates lead to higher debt servicing costs, lead to lower earnings leads, lower stock prices, layoffs, etc. The crazy cycle. They expect pain for households and businesses, meaning they will choose recession over inflation. You lose your job? Great. That's what we want. Pain. Put millions on the street, which means prices will come down because you won't be able to afford anything. And if you lose money by hodling in the stock market, crypto, real estate, then great. Now you're poor. Now you can't afford goods and services, which will also help bring down the CPI. So everything here, we agree violently. but let's talk about a couple of details. We go back to this, and I've spoken about this a lot. And today, coincidentally, thank you to Sanjay for sending this in to me this morning, debt remains a problem. This just came out. US national debt just surpassed $31 trillion for the first time ever. This is October 5, ladies and gentlemen. We're breaking record. What about timing of this video? It's kind of crazy. But $31.1 trillion. And during C19, obviously, countries all over the world had to mobilize assets, print a truckload of money, etc. We all know that. And here, the debt is still accumulating as we go forward. And this is a new debt milestone, but many feel uneasy about it because, obviously, the high interest rates, higher debt servicing costs will smash GDP growth. Of course, high interest rates smash GDP growth, and higher servicing costs means higher deficits. So we know the debt is a huge problem. Let's talk about this. This is kind of the premise of what I've been talking about, as well as how I believe when you increase interest rates, you smash the economy, you take it into what I call financial Armageddon. This formula here also incorporates employment. So again, you increase the interest on debt. We saw the debt is huge. I haven't mentioned it yet, but there's also something like 140 trillion of unfunded debt in the United States, but that doesn't matter. But you increase the interest on debt, you slow GDP growth, which also means you smash the economy and you blow deficits. Now, this Okun's law is a 1 percentage point deceleration in GDP growth over the course of a year trims employment growth by about 800,000 jobs per annum. This would also increase the unemployment rate by about half a percentage point and shave a few points off the PCE deflator and CPI as we go forward. It's all related. You can't do one without the other. You can't bring inflation down without smashing the economy and smashing GDP. So we agree on that. Now, the other angle that you kind of hinted at, which is, you'll own nothing and you'll be so happy. We keep hearing this again and again. And the more, sometimes it's almost like an echo chamber, but the more you hear it, it's like, God, that's so weird. Who would ever do that? But then you see the nuclear arms race towards getting a central bank digital currency in place. That is what gives you pause. So here, okay, you are now poor. I agree with you here. This could be this great reset angle. I don't know. I doubt it. My confidence level in this is very low. But now that you are poor and have nothing, I can get you to embrace universal basic income from a central bank digital currency because you have no other access to cash. And central bank digital currencies are designed to run on negative interest rates, to basically steal from you and control you. The ultimate in surveillance, control, and robbery. So I don't know, it's a bit of a stretch. I don't know if I agree with you or not. But then it made me think, create a cashless controlled group of commoners. That is a new phrase that I made up, and I'll tweet it later. Maybe the WEF could use it as their slogan or tagline as they go forward. But that is definitely another thing we agree on. So next point number 3. The Fed is guaranteed to pivot at some point because they have a dual mandate. Target annual inflation 2%, keep unemployment low. Yeah, and low for them, say they can go 4%, 5%, it's fine. But this means they can only raise rates to fight inflation as long as unemployment numbers are acceptably low. Okay? But because the unemployment rate is at historical all-time lows, the Fed believes they've got plenty of room to destroy demand by raising rates at the expense of increasing unemployment, aka they want you to lose your job, as effed up as it sounds. And Lynn Alden explained this concept in her June 2022 paper, and the fact that it would not be possible to increase the unemployment rate as a measured amount by raising rates, as doing so would kick off a vicious recessionary cycle. Yes, technically what you're talking about here is Okun's law that we just covered. So let's talk about the demand destruction. What is actually causing the inflation? And here, the bulk of our inflation is attributed to supply side issues, not demand side. And it's very clear that the Fed does not control supply side. We'll talk more about that later in the Wrinkle. So again, we agree inflation is too high, but we can't increase supply. So we need to reduce demand. That means a recession. Boom. Beautiful little simple graphic of exactly how the world is working today. Step number 4. We're agreeing on quite a lot of stuff here. So wonder where this goes. Maybe the markets will be very bad in November and December. Look at the charts from the perspective of the Fed. The Fed is keenly aware they are a center of attention. Money printer go burr. They've been embarrassed. They've been wrong. They're going to come back and prove themselves and burn this country to the ground, and at the same time destroy all emerging markets and even some G7 countries in the process. But wow, unemployment is at all-time lows. There's plenty of room to destroy jobs and fight inflation. Okay, now we're going to take a trip down the employment road, which I rarely talk about, but here, another point is number of jobs available at an all-time high. There's plenty of jobs to destroy tight inflation. But no. So there's a lot of nuances to the labor market statistics. Many times they count the job postings multiple times because there are multiple channels. You know, people have a job posting, goes to 15 different websites, posters, magazines, etc. It's all over the place. That's the one thing that's kind of different. Second thing, the jobs are, I'll pop this up, are part-time jobs. And of course, we've also had the Great Resignation. Now, this is where I'm going to get a little bit political here as I go through this one. But we just had the JOLTS, which is the Job Opening Labor Turnover Survey. And the JOLTS report jolted the market. In fact, it's kind of funny. You hear this number tank, it's kind of a bad result, and the markets rally because the markets want to know that there are no jobs. So the Fed will pivot. It's kind of really, really bizarre how the world works. But here, the JOLTS is a very messy number, but given it just had the largest drop ever from about, I think, 11.3 million down to 10.3 million. My eyes aren't good enough to read that exact number on the chart. But going from memory, somewhere like that is the biggest drop in history. Over 1 million jobs disappeared in the August report. Companies are cancelling, looking for 1 million new workers. It's still a healthy job market, but it went severely the wrong way in August. We have another jobs report on Friday. We don't know what that's going to say yet, but we'll see. But this is a very good early indicator. And the other thing that's very important, we did have the Great Resignation, which was triggered by C-19. People got fed up. They said, take your job and shove it, or whatever the expression is. And 47 million people left the job market. And this is part of the problem here when you look at this data. There's a couple of things I do want to point out about this graphic because I added another one I've added some annotations, but the big one is I blew up the biggest JOLTS fall ever. And because it's yellow, I am having a hard time seeing it, but it went from, anyway, 11, you can see the yellow line crashing down. I blew it up 11.8 to 11.1 down to 10.05 million in the space of 8 weeks. And that is staggering. I think it's definitely going to be in the 7-digit number very, very soon as we go forward. So that is the JOLTS number. And also, everything is different now. All of the employment markets are different, very different. Let's look at this other one. This is, wow, labor force participation hasn't been this low in 40 years. Again, Great Resignation, ladies and gentlemen. People are lazy. They shouldn't be at home trading crypto. They should be out there competing for jobs and not speculating on the market. We'll teach them. So maybe the Fed wants to drop the hammer on these people that are staying home. But this is a very, very important chart. And again, thank you to Sanjay for getting it to me this morning. This is the Beveridge curve. And it's one of the simplest ways to explain why the Fed is raising rates with such confidence and at such an accelerated pace. One, yes, C-19 did create this big shift with, 1 million plus deaths, a lot of early retirements, and all this terrible stuff that actually happened. But also the Great Resignation and continued drops like the JOLTS of over 1 million people in a short window of time is kind of perplexing. So on this chart here, I put a little red ring around the JOLTS report 8/2022, and also a green box to mark soft landing and red box for hard landing. So what this chart actually shows you is the correlation between the vacancy rate and the unemployment rate, the number of jobs open and the number of people unemployed, and you get that perfect balance. And you can see all the gray lines are way, way above normal. You got that gray line across the bottom, that's the pre-C-19 vacancy rate. And now there's a lot more vacancies than ever before. Again, there are many theories as to why that is, but it's coming down fast. Now, the question is, can it get down vertical enough to hit the soft landing box? I don't think so. So I basically drew 2 arrows where I believe the line will fall, and it's probably going to land in the hard landing box. So that's just a simple matter of fact. And we believe, although the job openings rate, I think, went from 6.8 to 6.2%, that's 1 million jobs. The hiring edged lower and layoffs went through the roof. Everybody is laying off. And remember as well, companies watch companies, and the smaller companies watch the bigger companies. You got Facebook kind of freezing, reorganizing, restructuring, which is code for you know what. Google's doing the same. Everybody's doing the same. And that is going to hit hard. And then all these other companies are going to do it. So the next 3 to 6 months, I think, are going to be very bad for employment numbers as we go forward. But they may count somebody as having 3 jobs as having 3 jobs, when really they're doing 4 hours driving Uber and whatever, 10 hours in the gym or something else. Who knows? They are miscalculating the actual job numbers. So next one is, wow, wage growth has been up nonstop. People are making too much money. This needs to stop to fight inflation. So just today, this came out. And this is from the, I have a note somewhere, hang on. ADP chief economist. ADP is the head payroll company in the United States. Her name is Neela Richardson. And she said, going from 16.2% annual pay growth last month to 15.7% in September was extremely notable for us. And it says, based on the upcoming jobs report data, it shows that maybe wages and wage inflation will not be a big driver of inflation in the future because it's stalling out. And this was a very positive sign. So in terms of that, yes, it's stalling out. And of course, that's what a high unemployment will do. People will be desperate. They'll take $10,000, $20,000 pay cuts to just get a job. Now, next here is, wow, labor productivity is at an all-time low. These unproductive, overpaid workers are contributing to inflation. We need less jobs and more competition. Make them struggle. That'll do it. So let's talk about productivity, and it has been shocking. And I believe this is all tied into the Great Resignation. People are not as hungry, not as motivated as they used to be. Perhaps, I could be wrong. But in short, labor productivity decreased 4.6% in the second quarter of 2022. Output decreased 2.1%, while hours worked increased 2.6%. This marked the sharpest decline in labor productivity since 1948. That's about 74 years ago, if I'm not mistaken. That is staggering. So people are being hired more, working more hours, and producing less. So we're not sure why, but again, that's a very alarming statistic. Again, since 1948. Next, why does productivity matter? Well, the prerequisite for more consumption is not more money. It's more production. More money helps more production. But the faster and more goods and services that an economy produces, the faster and more each individual can consume. Production determines consumption. So this is like a bag suffocating the economy. Okay, like the way I have my increased interest rates smashes GDP growth, deficits, etc. This is another one of those things that just crushes it down, and it's really, really concerning to many people, including people like Elon Musk again. So number 5. Inflation is the number one issue. According to a recent poll, in fact, I posted this exact poll myself, people don't care about other things anymore. They're only caring about inflation. And it's the number one issue for American voters at a whopping 29 to 35%, following gas prices, etc., etc. And do you think politicians want your vote? Hell yeah. Keep in mind, average American voter is more negatively impacted by inflation than a crash in stocks, real estate, and crypto. This is where we differ a little bit. So let's talk about the number one issue for people. Is inflation? Sort of. I agree. It's the most talked about issue. But what people really care about is wealth destruction. That's what hits them. And let me prove it to you right now. So first of all, if you look here, the majority of Americans, 58% right now, own stock. It's down off the highs. It used to be about 63%, but now it's about 58%. So not everybody owns stock, but it is the majority of people that own stock today. Now, if you break out where the wealth is held, how it's held by all the different cohorts, the top 1%ers you can see here, most of their wealth is in their business equity. Again, money is not earned in a paycheck, it's made. Remember that, ladies and gentlemen. And then you have the purple is net other financial wealth. Green is home equity. So you can see for the majority of people, except for the bottom 25 percentile, the majority of people up to the 90th percentile, all of their money is in real estate. It's in home equity, okay? And that's what we're going to talk about in a minute. And of course, The purple stuff is kind of financial market, stock market stuff as well as we go forward. But what's happening now in the real estate market? It has taken its biggest hit since 2008. And we all know what happened in 2008, the global financial crisis. Real estate got smashed. But real estate will tank, as I've been saying, 15 to 20% over the next 12 months. Luxury home sales are down 28%, the biggest drop in history. See, we're making a lot of history now, where things that haven't happened in 70 plus years. Average mortgage rate is 6.7%, highest since 2008. Home sales are down 7 straight months. New listings at lowest level since 2020. And new home builders, this is the first thing that ever happened to me. I have Lennar serving me up advertisements, buy this property, 20% off, target marketing. You got home builders going direct to consumer. Please buy this stuff. Take it off my hands. I've never, ever seen that before. So that's an important thing to think about here. The increase in real estate is destroying people's key assets, which is real estate. Point number 6, nearly there, ladies and gentlemen. The Fed and their cronies in Congress both want the same thing at the same time. Your vote, which means fighting inflation, destroying demand, jobs, economy, and the value of all of your assets to make you poor. It's the only way the Fed knows how. Now, in case you might be wondering, do US politicians really care that much about you getting your vote and being reelected? Why do you think, this gets a bit political here, so warning everybody, why do you think Trump encouraged his supporters to protest in front of the White House when he lost the election on January 6th? Why would he risk a violent riot breaking out on national television? Could it be that getting reelected is more important than people getting hurt? The answer is, in the minds of the decision-making elite, hell yes, it is. And this is why you can count on Jay Powell to stay hawkish until the midterm elections are over. Okay, interesting. Once midterm elections are over, November, December, accounting for runoff, etc., December, that's when the Fed and politicians will have the flexibility to change their tune and pivot, and they will have your vote by then. Recall how fast Jay Powell pulled a 180 from dovish to hawkish only weeks after being re-elected. So very, very interesting theory. And because it's a hot potato, I'm not going to touch it. But it's a very interesting angle to look at. But I will talk about some data-driven facts that are kind of interesting. One is, I posted this a while back. Woohoo. Biden was proud he passed a $500 billion Inflation Reduction Act, which was designed to reduce inflation, but it increases money printing, which increases inflation. So I never really understood that one. And then 3 days later, victory, 0% inflation. He actually said that. And that is definitely pandering to the voters. So I agree with you there. Leaders do pander to the voters. But let's talk about true inflation. As you know, governments cook the books when it comes to true numbers. This is from Shadow Stats. And as you can see here, true inflation has never been under 5% since 1987. That's over 36 years ago. And the average is more like 9 or 10% or more. That's the true inflation. And I always said that the Fed and the US government wants to inflate their way out of debt, which is a very clever and easy way to do it. So they always say, oh, our target inflation rate is 2%, but really it's going to be 8, 9. We'll pretend it's 2. So that's why all of this stuff is very hocus pocus as far as I'm concerned. But let's talk about the president's playbook. This is another piece of interesting history. And this is kind of Stoke the stocks, okay? Reagan knew the secret. I didn't go pre-Reagan, but during his reign, he trebled debt from 900 billion to 2.6 trillion, leading to the Dow to more than double from 960 to 2,200 points. Clinton didn't have to print as much money to get the market up because we had the internet and the dot-com revolution. If you are old enough to remember that, everything went bonkers. Now, Bush Jr. had to almost double the debt, and still the market ended lower than when he took over. And Obama doubled the debt, and I think he went from 10 to 20 trillion, but he was also hit with the global financial crisis in 2008. Trump added 8 trillion to debt, but he had C-19. And Biden so far has added 3 trillion to debt. And the stock market is exactly flat. You can't make this stuff up. Literally, the S&P 500 is at the exact same level it was when he took office 1.75 years ago, whatever it was. And here is the scorecard. So the point I'm trying to make is leaders love to pump the stock market. This goes back to the other point too. Trump tweeted, I think, about the stock market being at all-time high 60 times under his reign in the first year and a half when he was there. So again, the presidents know they need the stock market to go up. They need the housing market to go up, or they're not going to get reelected and they'll be extremely unpopular, because that's where it hits people. So I just thought I'd intertwine that little piece there, but you're dead right. I agree. Pandering happens. Now, 7. You might argue, boom, all is priced in because markets are forward-looking, which is 100% true. However, consider the reverse. What if the stock market goes up, or at least maintains at the current level, stays flat? If stocks maintain current levels, that would mean company revenues remain unchanged and no one would have to lose their jobs. This would then indicate spending would be unchanged, and therefore high inflation would be unchanged and therefore unresolved. Of course, increasing the supply side of the equation would help combat this issue, such as resolving supply chain issues, increasing oil and gas supplies, commodities, etc. These are much harder issues that we don't have time to solve. So yeah, this is dead right, and there's so much out there that impacts everything. You know, we have declining birth rates, we have aging population, we have huge amounts of debt, we have OPEC playing funny games, we have supply chain issues, we have zero C-19 in China, and everything is a mess out there. We totally agree on all of that. Productivity is all-time lows. We're violently agree, but let's talk about the wrinkle here. This is the news today. It looks like a lot of news today, new all-time high debt, etc. But OPEC have a meeting in Austria today, and they decided to cut production by 2 million barrels a day, which will increase the price of oil, which will turn on inflation again in other areas. And you know, the Fed talks about controlling inflation. They don't control inflation. They destroy economies. That's the difference. So this could be an excuse. This could be both harmful and beneficial. It could drive up inflation again for gas prices, but it could also be an excuse. It's like, okay, got inflation back again, but it's not our fault. It's OPEC's fault. Blame the Saudis, blame C-19, blame Ukraine, etc. This was the playbook early on, but this is a wrinkle. And guess who was also there today in Austria? One of the ambassadors from Russia, coincidentally. And I tweeted this morning about this, got a little political early morning this morning. This is shocking. The betrayal of the White House. People criticized Biden when his plan to visit Saudi Arabia and hang out with this guy, and we all know the type of stuff he does. I hope I'm around tomorrow. But everybody criticized it, but he should have known better that these two were in bed together. These two have a master plan. Okay, so it's really, really weird situation what's going on in the geopolitical verse out there too. So let's talk about pivots, because this is really the lid on the markets. So pivots are happening all over the place. China trims lending rates again. Turkey cuts interest rates again. Australia central bank slowed the pace of rate hikes. And of course, you can debate and argue, is slowing the pace a pivot? Well, it is kind of a change of direction. And the Bank of England just made a hard pivot in monetary policy, and the UN calls on the Fed and other central banks to halt interest rate increases because they are smashing emerging markets and the global economy, driving it further into a recession if it couldn't be bad enough already. And also, that is just what's happening. So things are tweaking. Now, what the Fed does, we'll see. I'll talk more about that in a second. But let's look at the world, what it looks like in terms of who's tightening and who's not. So easing is blue, light blue. Tightening is pink to dark red, depending on how hard you tighten. You know, down 15 basis points, up 15%, or I don't know what the metric is for this particular thing. But I thought it was interesting to see there will be a lot more blue in 3 to 6 months on this map. That is guaranteed, and we'll track it for you. But let's look at where we are in terms of the hike schedule and where we are redlining. So right now, we just did 75 basis points on the 21st of September. Next meeting is the 2nd of November. A lot of people are saying another 75 and then another 75 in December and then all the way through 2023. That is just impossible. It's ludicrous. It cannot happen. And I didn't expect the world to cry out so early about the damage that's already been done. And maybe the emergency meeting at the Fed on Monday had something to do with that. I don't know. But my estimate is maybe 50, then 25, then stop. I could be wrong, as they say, just a guy on the internet. But what I do know is right now, the raises beyond 25 to 50 basis points more start smashing things real hard. And I've always said that once you go beyond the Fed's funds rate of 3.5%, things just get smashed. And remember, all the hikes that have taken place, let me show them to you. Again, we did 25, 50, 75, 75, 75. June, July, September, 3 75ers in a row. That's never happened in the history of the world. And the impact of these hikes takes at least 6 months to work through the system. So the damage that's been inflicted by these hikes, we will not see for another 4 to 6 months. That is important, ladies and gentlemen. And again, they destroy things on the way up and they'll destroy things on the way down. But the way down will be a lot more construction. So let's summarize where we are with all your points. And then I'll do my take on where we are in Q4. So first of all, inflation is high. We agree. Fed is threatening pain. We agree. Fed guarantees pivot at some point. We agree. Job market is great. Wage inflation is high. Disagree. Job productivity sucks. We agree. And then inflation is number one issue. I sort of agree, but I think wealth destruction is really the true issue. What the surveys and the papers pick up is a separate issue. And then I don't know why the numbers got screwed up there. Oh dear. Anyway, game plan, interesting election angle, possible. I can imagine your theory, but remember, November is only 5 weeks away. I think the elections, not even. The elections are like 32, 33 days away. So not far. All stays the same. Disagree. And also, I also believe recession is here and people will lose their jobs. There's no turning that back around. It just takes a while to get through the system. So we're in a recession. We're enjoying the third quarter of recession. We don't know how bad it is yet. Will it be mild or heavy? I don't know. Rest of the world in a recession for sure. And them continuing to smash things will make the recession deeper and longer. That is the question. But their jobs will be lost. No doubt about that. So why I believe the market will be up from here in Q4. Well, it's already gone up quite a bit in Q4. Just to touch on something, it was uncanny the way the day Biden came into office and today the S&P 500 is exactly the same, which is unusual. But we did see the market go up 6% in 3 days, which is kind of staggering. So the market's bottom fast and are forward looking. There's $3 trillion in the sidelines that's getting impatient. People are paid to allocate and paid to deploy capital. They can't sit on cash. They're not paid to do that. So they're getting itchy. I do believe the floor of the S&P 500 is 35 to 3,600 points, barring any black swan event, okay? If something bad happens, if there's a Credit Suisse and a Deutsche Bank default, all bets are off. If somebody fires a missile, all bets are off. Now, we had the worst first half in 50 years, and Q4 is typically a bumper month. It's a go-up month, and markets move fast. Remember, S&P 500 went up 6% in 3 days, and it shows you. I always say you want to be on the train when this thing turns around. And finally, fiat debases at 14%. So if the markets aren't going up by 14%, and you can knock off your inflation of 5-6%, that gives you 9% return, you're not treading water. And sitting on cash, it's a melting ice cube. The debt keeps going up. Money printing keeps going up. Nothing's stopping. So that's where we are. So that's my take on Q4. We'll see if I'm right or wrong. Again, I'm just a guy on the internet, as they say. So thank you for that. How to challenge me. We take these questions from Patreon. So thank you all for being there. And it's the beginning of the quarter. Things are hard out there. So hope you enjoyed that. That was a long one. I'm almost out of breath. 34 minutes, a ton of information. I want a big thank you again to M11 for the brilliant questions and laying out your case so perfectly. Excellent work. I hope you like my responses. And we agree the majority of the time. We totally agree. We just disagree on where the markets could go and how deep we are already and how early the pivot will be. And a pivot is kind of a softening or change in direction. If the Fed does 50 basis points in November 2nd, then we'll see the market react because that'll be the end of the cycle. Be 50, maybe 25 more, and then stop. Now, if they elect to do 75 and another 75, that's it. Everything's broken. Then we need to start hoarding butter and bullets and Bitcoin and whatever else. Thank you all. Have a good night. I'll see you all tomorrow.